presentation contains current opinions of Javaid Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Welcome everyone to the weekly edition of the Market Wrap YouTube Update. I'm your host this week, Javaid J. Ansari, Executive Vice President here at Compact Asset Management, filling in for your longtime host, Mo Ansari. He's taking a little bit of a holiday Thanksgiving break, and hopefully all of our watchers and listeners out there are able to celebrate the Thanksgiving holiday with some family and friends, and really hopefully try to have that attitude of gratitude. A lot to be grateful for, I think, with the market achieving the returns that I think surprised most people, including us here at Compact, in terms of how great things have been. So we'll definitely take that. And we'll talk a little bit about today as we reflect on 2024, as we do those holiday cards, see all of those things that we've accomplished and experienced throughout the year, and really pivot to 2025, what's on the horizon. And particularly as the new administration, Senate and House, they really start to put their legislative agenda together. We're starting to get a little bit of inclinations through appointments, and that was the big news today on Monday, November 25th, was the appointment, or not the appointment, at least the nomination of Scott Bessent as potentially the Treasury Secretary, and exactly what were the market implications of that and could be going forward. And we'll talk a little bit about that today on the YouTube. But of course, please do subscribe and like our YouTube channel. You can go to www.compact.com/YouTube. Hit that subscribe button. And of course, if you'd like us to talk about any particular topics, either here on the YouTube or on the podcast, just shoot us an email at invest@compact.com, and we'd be happy to address those right here on the production. So just looking at the markets last week, we saw the S&P 500 up 1.72%. So just getting right back in stride. Has been a great 2024, looking at almost 27% year to date. Just fantastic type of returns, really just built upon the back of what we've seen is a little bit of disinflation, not deflation, but disinflation. And that's really, you couple that with, I think, still robust GDP growth, earnings growth, and that's your recipe for a really strong bull market. And so that's what we've seen so far this year. Sprinkle in a little bit of multiple expansion as well, and that's what gets you up to that 27%. But also nice to see the Russell 2000 up almost 4.5%. So this is an area of the market where you don't have quite the fundamentals that you have in the large cap companies, but the fact that we're starting to see small cap companies really since July of this year start to kind of stealthily outperform. Haven't quite broken out yet. We'll talk about that in the technicals. But really starting to show that leadership, that's a very positive sign. That's a very positive sign that the market is broadening out and likes what it's seen, at least so far, from the election results, the early kind of verdict, if you will. Ultimately, we'll see kind of how things pan out in 2025. But the early verdict, as long as we see that small cap outperforming, that's a very positive sign. Still, EFA, EM still kind of struggling so far this year. I think there's there's some, really global stocks out there that are maybe worth investing in. But when you look at the asset class as a whole, particularly if we are going to see more tariffs and kind of protectionist types of foreign policy and trade policy going forward, doesn't necessarily bode well for emerging markets as well as developed markets. So something that we really want to follow. Something I look at very closely also, and I think has been one of the biggest moves since the election, has been the basically strength of the US dollar relative to the euro. We've seen just a dramatic decline. We started really in October, but since the election has continued, and finding a little bit of support today, but we don't really want to see that euro go much, much lower, because that might indicate that we might be headed towards some sort of crisis within the European zone. So one of the indicators we're watching really closely when it comes to international. And still the NASDAQ just kind of trucking away, even though it has that higher valuations, still actually outperforming the S&P going forward. Looking at the overall sectors, we see the staples and materials and utilities. So not your kind of growthier type of companies, maybe more of your value-based type of companies getting a little bit more of a bid. You can see on the lower end, we saw consumer services down the most. Mostly that was driven by Google. The Department of Defense, or Department of Justice, came out and said that they might be pursuing or trying to pursue a breakup or at least a separation of Chrome from Google, given the fact that Chrome uses the Google search engine and is kind of really, I guess, enclosed type of infrastructure there when it comes to search in the web browser. So they might be looking to break that up. I don't know how long that's going to go, particularly with the new administration maybe looking to kind of just open things up and kind of let things fly. So we'll see if that has some legs to it, but definitely hurt a little bit of the communications sector, primarily driven by Google. But overall, things are looking rather rosy here across all the different sectors. And once again, if you look at like a real estate type of sector, this is more of your interest rate sensitive type of sector. We've also talked about how small caps in the past are very interest rate sensitive. So the market's starting to give us some indications that maybe interest rates have made a short-term high and are starting to come lower. And that's just good for the overall market, given that we were kind of starting to creep into that danger zone around 4.4. Oil basically just slightly down or at $70 a barrel. I don't think it's really giving us much indication there of kind of where things are at. We'll take a deeper look at that in the technicals. And once again, bonds rallying, but I think the key thing to really focus on is once again these high yield bonds up 2.8%. As long as high yield bonds are continuing to the upside, I think that's very positive. And really just kind of give you that kind of signal through all the noise. Particularly, I do think we are going to see some volatility next year, just given where the valuations, we're starting on overall valuations with the stock market. But if high yield continues to hang in there, I think we'll be in a very, just overall still upward trending market throughout 2025. We'll dive more into the Treasury here in a second. So pivoting towards 2025, here we come. Goldman came out with some of their kind of expectations, and you always got to take these with a grain of salt. No one knows what the future is going to hold. But I do think we are going to be generally in this type of picture. And so I think key thing is you look at GDP growth coming down a little bit from where we were in 2024, but still really robust, nowhere near like any sort of 0% type of recessionary type of economy. That's just not happening in 2025. So that's really good. That's ultimately the main thing that we care about. And the market, of course, if we were expecting any sort of recessionary type of volatility next year, we wouldn't be at all-time highs today. PCE, we're actually going to get some PCE data later this year, but you can see the general trend is still for this to come down. And then that's really where you're seeing then the expectations around the Fed continue to come down all the way to the Fed funds rate being down to 3.4% by the end of next year. I don't know if we quite get all to that level. I think the key thing when it comes to overall inflation is going to be housing. If housing remains sticky, I think we could be a little bit closer to this level over a period of time through 2025. And then maybe we don't quite get all the rate cuts that we're expecting, and we probably just maybe get down to 4%. So not the end of the world. I think that's, it kind of favors certain sectors, particularly financials. If the long-term interest rates remain high, but short-term interest rates remain low, that's very profitable for them. So that's why you've really seen financials do very well here recently. I don't know if that's going to continue because I do feel that housing is the kind of last really thing that's holding up inflation. And unless we really attack that from a supply side type of policy, it's really going to be difficult to bring that back down. So we'll see how that plays out over time. But I think the key chart or the key thing to really continue to watch here is this 10-year U.S. Treasury. You can see right now the market really expecting, or at least Goldman, expecting it to really stay right where we are today. Anything really above 4.5% is not good. Anything, we have some wiggle room all the way, I'd say, down to almost 3.6. If we got down to 3.6 or below that, that would then start to indicate that these growth numbers are just not in line with where we're headed. So I think this is ultimately what's going to determine this. Earnings are going to be relatively good if we have earnings growth and GDP growth in the 2.5% level. But it's just going to be really those multiples that we're applying to those earnings, and that's all a function of interest rates. So depending on where interest rates go, if they go a little bit higher, if they're a little too aggressive, maybe with the tariffs and the market wants to price in, some higher interest rates, then that's going to cause some volatility in the market and just kind of create, I think, some ultimate, just maybe anywhere to 10 to 15%, your normal type of pullback in 2025. But if we're looking at 6,500 on the S&P at the end of 2025, that's really just 8% above where we are today. That's a very normal type of expectation. So I think 2025 is going to be actually normal. This year was very abnormal in that particular regard, but we'll take it in terms of abnormally good. I think next year is going to be a little bit more normal when it comes to both return expectations as well as volatility expectations. Looking at the news this week, so last week we had the housing starts declined a little bit. Once again, that's why I'm thinking, overall housing is going to remain a little bit sticky here in terms of inflation. And initial claims also declined to a 7-month low. So basically that's unemployment claims. So basically job market's still looking really good. Not a lot of news this week. Of course, we have the Thanksgiving holiday on Thursday. We'll get some housing data here tomorrow. Really, the big ones are going to be more of the PCE that comes in. I think we do get PCE. We get a little bit of GDP, personal income here. The Fed, we kind of watch that really closely. It gives you an indication of how the market's doing or how the consumer's doing. So not a lot of economic data this week, so we just kind of probably not going to see a lot more volatility after today as people kind of take off the rest of the week, and then we'll start repositioning that first week of December. So just transitioning into the technicals, as you can see, Mo's been talking about the fifth wave tops here. That looks like we might be putting in. We did talk about this island top here that happened right after the election, but I did go back and I noticed we also had an island bottom here right before the election. So, it looks like we filled this gap here last week, so that's all very positive. Island bottoms also tend to be over pessimism. Island tops tend to be over optimism. So the market's really just kind of gyrating back and forth, but still maintaining that upward momentum. And once again, as long as high yield bonds continue to trend upwards, I think the stock market is going to be in a general uptrend. We can see some 5% pullbacks from time to time. That's just for any variety reason. I think mostly those are going to be associated with higher interest rates, but as long as interest rates are kind of lower, then I think the stock market can trend higher. This is kind of what we're looking at of maybe that pullback area sometime in 2025, anywhere between 5,600 and down to 5,000. But overall, still trending very much to the upside on the weeklies. And then, you get that fourth wave pullback, and then we ultimately get another fifth wave ultimate high. NASDAQ, once again, holding in there really well. Similar type of charts with an island bottom here. You got an island top here. Not looking as bullish to the upside as we saw both the S&P and small cap really rallied here recently. So I think you're just seeing still a little bit more of that rotation. NASDAQ has been the place to be for the last 5 years. So the fact now that we're seeing that broaden out, I think is very, very constructive going forward. So something to think about if you're really NASDAQ heavy. I wouldn't necessarily be taking a lot off the table, but maybe not doubling down on that trade going forward. And if you look at the weeklies, once again, Mo's dot plot is to the upside and still just trending very nicely to the upside on the NASDAQ. This is, once again, I think the key chart that we all need to focus on headed into 2025. And once again, this is the 10-year Treasury. You can see a big move lower today, gap below, I think this is the 20-day moving average. Once again, the Treasury Secretary nomination is Scott Bessent. He's really kind of advocated a 3-3-3 policy. If you haven't heard about this, this is, I think, rather important if this is what they're going to prioritize headed into 2025. And what 3-3-3 means is they're going to try to target a 3% fiscal deficit. Right now, the fiscal deficit's around 7 to 8%. So that would be a major kind of deduction in the deficit. I don't know how they're going to do tax cuts to get the deficit down to 3%, but we'll see how that happens. Going to happen probably more on the spending side of the equation, and you have the Department of Government Efficiency ran by Elon Musk and Vivek. So we'll see how this all plans out, but ultimately I think it's going to be a lot harder for them to kind of get to all these kind of campaign goals that they've outlined. But if we're headed in that direction, that's a positive sign. So once again, 3% overall deficit, 3% in overall GDP growth. So that would be much higher than what the market's expecting today, and trying to really do that through deregulation going forward. So we're hopeful that I think there is some efficiencies that can be gained there if we do focus on that. Hard to politically get those done, because both Republicans and Democrats, they want to pull a lot of the strings there. So we'll see how much they're able to actually deregulate over a period of time. And the final part of the 333 policy is 3 million barrels of oil exported from the U.S. So also a very kind of pro-energy, really making the U.S. a bastion when it comes to energy exports across the globe. So really trying to prioritize that, and I think deregulation will play into that as well. So once again, the market, I think, really with the reaction to the downside on the 10-year, that's very positive, getting away from that danger zone of around 4.5%. So as long as we meander in these levels going forward, the valuations aren't extreme, and I think we can continue to the upside. So the key chart that we'll continue to update you on here going forward. Small caps, this is the final piece. Mo and I have talked about this top here back in October of 2021. We got there today, didn't quite get above it. I don't know where we're trading at the time of this recording, but 245 is the key level. So hopefully maybe this week we get above that and we consolidate those gains, headed into next week. But I think that's a very positive sign. If we do get above that with this very long base that we've been in here over a period of time, small caps could be leading for some time going forward. So we'll see how that plays out, but definitely one of the key charts to also watch. Crude oil just kind of bouncing around for the last couple of months, just kind of telling us maybe the situation in the Middle East is definitely not escalating. So as long as crude oil is just kind of bouncing around, that's a good sign. And gold, a big down day today, really maybe on the back of that downward movement in interest rates. We'll see. I think gold maybe have made a fifth wave top here. I think this was a lot of the uncertainty trade headed into the election all year. You can see it was just continuing to just relentlessly go up. And then since November has started to trend back down. So now that we kind of know where we're headed, at least, as far as the composition of government, we'll see ultimately what they're going to pass. I think gold maybe has some more downside, potentially headed back down to this 200-day moving average here at 2,440. So that's it for this week. But once again, please do subscribe and like this YouTube channel. Mo will be back next week with his expert analysis. If you'd like to hear more content from Compact, just feel free to log into our weekly podcast update as well. Until then, I wish you all a very, very happy Thanksgiving. Hopefully you have time to spend with family. Enjoy this, what has been once again an incredible year here in 2024. And I look forward to hearing from all of you at a later date, and we will be back next week. Until then, good trading.
This presentation contains the current views and opinions of Javaid Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.